Welcome to S&P Capital IQ's quarterly update on the leveraged finance market. I'm Ruth McGavin, a member of the Leveraged Commentary and Data team in London. I'm going to talk about how the European loan market performed during the third quarter and what the prospects look like for the run to the year end. Certainly, the third quarter has not been plain sailing, as you can see from a glance at the monthly returns of the ELI, that is, the S&P European Leveraged Loan Index. Market value losses in August and again in September dragged overall returns down, although neither month was as bleak as June. The cause here, of course, was widespread volatility in the global financial markets, arising from a multitude of different sources. Greece early on in the quarter, then Chinese equities in the middle, plus a real mishmash of other factors by the end, including the emissions scandal around VW. Across asset classes, many different sectors have suffered, and risk-averse investors have had plenty of scares to hide from. Totting up the European leveraged loan issuance that managed to come to market during this sticky and unsettled quarter, total loan volume reached €10.4 billion, the quietest quarter since the end of 2012. Institutional issuance, meanwhile, amounted to €7.6 billion. But the impact of this third quarter volatility has been greater in US risk assets and in the European high-yield bond market than in European loans. Indeed, loans have been comparatively stable in the secondary market, despite the turbulence around them. If you take a look at the table, you can see the ELI just teetering over into the red in the month of September, compared with much heavier losses elsewhere, while the ELI's year-to-date returns are well ahead. Even so, loan market sentiment has undoubtedly cooled since the gung-ho second quarter. As you will see from the chart, clearing yields for high-yield bonds have been rising ever since the first quarter of the year, but loans have now caught on too, pushing the average reading up by nearly half a point, to 4.9% in the third quarter from 4.5% in the second quarter. This move put an end to repricings, which were rampant in the second quarter and absent in the third. In fact, all forms of opportunistic deal-making fell quiet in the third quarter. New issue volume to support refinancings tailed off to a mere €1.7 billion, the lowest quarterly reading for 4 years, while there were no dividend recaps at all. Heading into the fourth quarter, there is talk around the market that some issuers are considering a dividend recap, but market conditions will dictate whether or not they eventually step forward. So with opportunistic deals on the sidelines, third quarter volume relied heavily on M&A activity, and looks set to continue to do so in the next few months. Compared with the previous 2 quarters, third quarter M&A volume was down at €7.4 billion, and on a year-on-year basis, 2015's M&A volume is lagging well behind by 20%. However, by deal count, as you can see in this chart, there has in fact been slightly more M&A activity this year. For those who are wishing and praying for signs of expansion in the European loan market, this is surely an encouraging indicator. Turning now to consider investor appetite, the fundamental appeal of loans is still very much in place. For a start, they are less volatile than related asset classes, as we've seen, and in addition, leveraged loan defaults in Europe are very low at present, with a lagging 12-month rate of just 1.4% as per the ELI. On the CLO front, issuance has been sluggish in September, but there are a dozen or so managers that would like to price vehicles before the year end, if the primary loan market is sufficiently active and if the CLO arbitrage works. Demand driven by repayments has been tepid in recent months, as you can see from this chart. But several large repayments are in the works for the fourth quarter as sponsors forge ahead with IPOs, all else being equal in the equities markets, of course. On a final note, it's instructive to look at investors' response to September's deal flow. Some smaller deals, especially those that were structured a few weeks earlier during the summer and therefore carried the hallmarks of a more bullish market, had to work pretty hard to gain traction with lenders. One borrower had to add a second lien tranche, another had to juice up pricing after the early bird phase. But then consider VWR. It's large, it's liquid, it's BB rated with an attractive 2H recovery rating. This credit had investors banging on the doors, allowing it to flex down, to price at the tight end, and then to trade up on the break. So it's highly likely that we'll see a mix of upwards and downwards flexes in the fourth quarter, even if bearish sentiment prevails, as investors will demonstrate their appetite for larger and better rated credits while remaining picky and cautious on others. This brings me to the end of my market review. I hope you found it useful. Please feel free to email LCD with comments or questions. You can download the slides at slideshare.net. If you'd like to know more about the leveraged loan market, you can follow LCD on Twitter, Facebook and LinkedIn, or you can visit our free websites leveragedloan.com and highyieldbond.com. The links are all in the info section on our YouTube channel. Thanks for listening. I hope you'll join me again next time.